lot of people just learn about behavioral finance and then they don't understand the underlying principles. So I would recommend that, they look at that. And then there are also
Behavioral finance is a field of study that explores the psychological and emotional factors that influence the financial decision making process. It examines how people's behavior and biases affect their investment choices and how these factors can lead to suboptimal outcomes. By understanding the cognitive and emotional biases, the influence of our financial decisions, we can better manage risk and make more informed choices. Hello and welcome to the Honest Talk by Freak Folks. I'm Harsh Pandey. For this particular session, we have with us very special guest today, Miss Mitali Nikore, ma'am. She's a pioneering economist with 12 years of experience in gender mainstreaming development, finance, policy advisory, and social entrepreneurship. She advises leading multilateral organizations such as ADB, UN Women, and the World Bank. Her experience spans several countries in Africa and South Asia, as well as the United States and the United Kingdom. In recognition of her work, Mitali ma'am was facilitated with the Indian UK Achievers Honor, which celebrate the work of 75 young UK Indian students and alumni who have made an important contribution to their profession and society. And ladies and gentlemen, let me tell you her profile has so many things, so many glories, which I won't be able to explain in next few minutes. But I'm pretty sure during this conversation, we are going to learn a lot from her. So, moving to the topic of today's session, which we have chosen is understanding annuities with the help of behavioral finance. And thank you so much, ma'am, for joining and actually agreeing to share your thoughts with us.
Thank you. Thank you so much for having me. Thank you.
Thank you, ma'am. So, my very first request to you is to please actually address this question I have got. How can behavioral finance concept help us understand why some people are drawn to amenities while other may be wary of them?
So I think first of all, we have to go to the basis of behavioral economics before we even talk about behavioral finance. Because at the end of the day, the basis of designing behavioral finance products and attracting people to different products is actually rooted in behavioral economics. So when we think about behavioral economics, it's basically a field of study where we don't just do aggregates, because typically in standard economics or classical economics, which we call it, we only study the average rational individual. One of the first things that we start with in our economics classes in undergrad is that the decision maker or the agent is a rational decision maker, which means that they will try to optimize their trade-offs, and also that they will have full information. So this is a very important assumption in economics, that any agent who is making any decisions will have full information, which means that you have the full information to make a rational decision. You have all of the pieces of information clear to you. So say, for example, if I have to decide about an investment product, right, and I am a rational economic agent, then I will know, the assumption is that I will also know about all of the uncertainties in the different stock markets that I am investing in, and I will know that with full certainty. Now this is completely different from the real world. In the real world, we are not rational agents because we don't have full information. We don't have we don't know what is going to be the next say, for example, next pandemic or next a climate event or anything. So all of us are surrounded by uncertainties all the time. Recognizing this, economists came up with different models, and behavioral economics is one such field of study where it was sort of decided that, okay, maybe each agent will not have full information, but they will know about their particular area, about their particular country, about their particular geography. So they will make their decisions based on the best information available to them, and they will be drawn to certain different behavioral profiles will be there for different types of agents. And based on that, behavioral finance and behavioral marketing and the nudge theory have all come up.
Okay, I think you have described this very well, and I'm sure the people those who are watching this session they are going to find this meaningful. And ma'am, one question I want you to discuss, because you discussed about uncertainties. So I want you to discuss. Can you discuss like any common biases or heuristics that people might use when thinking about annuities, and how these might lead to suboptimal decision making?
So I think the most important bias that we always study in economics is present value bias,
Okay.
right? The fact that you want the returns of any investment as soon as possible. You would not want to, so you will always trade off any financial product, be it an annuity or any other type of product, which gives you higher returns sooner rather than one that has a cash flow such that you only get your returns after 10 years or after 15 years. And that present bias is, it's very natural, right? We don't know, again, it is a product of uncertainty.
Okay.
So if you know that in the future anything can happen, there will be uncertainty in the future, so that's why you are investing. But a product that gives you higher returns now is always going to be preferable to a product that gives you returns later,
True.
typically. But of course, you have different types of risk aversion profiles. This is all a factor of risk aversion. So it depends on how risk averse or how risk taking you are as an individual. Now, if I'm very risk averse, I will prefer any kind of financial instrument which will give me the returns today, in 2 years, or in 3 years, or in 4 years, maximum. But if I am a risk taker, then I will trade off high returns, I mean the uncertainty of getting returns sooner for going for, higher returns in the future. So the present value and the interest rate on which I, then trade this off matters. So I may say that, okay, for an annuity that gives me 10% annual return, I'm okay to get the return starting after 5 years. But for an annuity that only gives me 2 or 3% annual returns, that return I want starting immediately. I'm not talking about Indian markets, because obviously Indian markets the returns are much higher. But even in like developed country markets, getting 2-3% return even is a very big thing, because we are even seeing negative interest rates in some of these markets.
No, exactly. And thank you, ma'am, for this actually answering this question. And I have one more like, how do factors like age, risk tolerance, and financial goals influence whether an annuity is good choice for an individual?
So I think age definitely has a big role to play, because at the end of the day, you would not be able to invest in an annuity unless you are on, this side of 35, because obviously it's a very long term investment instrument. And you may want to go for some other, equity based instruments if you are a little bit, older, because again, you might want to have some quick returns. Um, also it depends on what is your financial portfolio at that time. If your financial portfolio is well diversified, then there is no reason to think that, okay, I should not go for annuity if you already have other instruments. But if you feel that, no, I have too many debt based investments already, then in that case an annuity may not be a good choice. So I think based on these two or three principles of diversification versus age versus, also how quickly you need the returns, so your overall financial position, these are the three main factors which will determine the investment decision.
Okay. Okay, and one more question, ma'am. I want you to discuss because this is something related to behavioral finance. So I want you to discuss like any like financial advisor. How can financial advisor use behavioral finance insight to better serve their clients and help them make more informed decisions?
I think more than behavioral finance, they need to just basically learn the basic psychology.
Okay.
So behavioral finance is a amalgamation of behavioral economics, which is an amalgamation of economics and psychology. That is what you do to create risk aversion profiles. That is what you do to create buyer profiles. That is what you do to create profiles of people depending on their, on their sort of consumer preferences in that sense, So I think that financial advisors have a big role to play in using behavioral finance. They must use behavioral finance, and they must study the basics of psychology as well in order to build these risk aversion profiles and buyer profiles, because only then will they really be able to understand how is it that a user can actually optimally invest with them. Otherwise they may not be able to connect with the user.
This totally makes sense. And one more question I have is like, how might cultural or demographic factors influence investment decision making? How can actually we account for these factors in our analysis?
So I think the most important thing is that one should look at gender. I think women investors have a completely different take from male investors. So this is the first thing that I would recommend, that all the financial advisors who are watching this and who are thinking about this, they should really think about gender-based, segregation of their buyer profiles, because women may have different concerns, may have different priorities from men, and it's important to cater to women as a market. Then the second thing is, whether you're talking about a class 1 or a class 2 investor, that is very important. The other thing is to look at whether your investor is geographically located in a tier 1 or a tier 2 city. That also is very critical, because these days we have in tier 2, tier 3 cities long gestation period investors who
Yes.
have high net worth, who have high family wealth, but they don't have too many opportunities to invest,
Right.
because they may not be seeing that many developments come out in their own city. So they might want to diversify outside of their city and even outside of the country, or they may want to invest in a good startup, new startups, or new technology, which may not be located in their own city. So there's a huge interest in tier 2, tier 3 city investors. So I think it's very important to understand and give the investors, I mean, to give the to give the buyers a lot of options, and say, no, these are the best ways of getting the returns.
Mm. Okay, I think it's like it's very hard to disagree with you on this point. And ma'am, one question, like it's again a kind of a request to you. Can you offer any practical advice for our listeners who are intended in applying behavioral finance concept to their own investment strategies?
I think that I mean, to their own investment strategies, it's a bit harder, because
Okay.
it's this is a tool which is more meant for financial advisors, I would say, rather than for the investors themselves. Because at the end of the day, the idea is to create profiles of the investors. So obviously the investors themselves cannot use this tool as much, but what investors can definitely do is to keep some of these ideas in their mind, so that when they are selecting their financial advisor, at that point they can think about, which financial advisor is actually giving me the most tailored solution
Yes.
based on my profile, and then go for that advisor.
All right, and I think, ma'am, there's a lot more to learn from you. But today, I don't want to take too much of your time. So, moving to my last question of this session, like it's again a kind of a request to you. Say, could you please share some tips or recommendation for listeners who are interested in learning more about annuities and how they can fit into comprehensive financial plan?
So I think your channel is obviously one of the best ways to learn about financial behavioral finance and annuities. Of course, they can see many of the videos that are there. They can also see, I think, if you look at some of the courses that London School of Economics has put up
Yes.
on behavioral economics. And I think it's important to learn about behavioral economics and not just behavioral finance, because a lot of people just learn about behavioral finance and then they don't understand the underlying principles. So I would recommend that they look at that. And then there are also some podcasts on uh, investor behavior and profiling investors based on their buying patterns. And
Yes.
I think some of these podcasts can be really helpful, especially, say, for example, the Financial Times has a really good podcast called Money Matters and
Okay.
Money Markets, and that can be useful as well.
I'm confident, like viewers those who are watching this session, they are going to find this meaningful actually. And thank you so much, ma'am, for joining and giving your important time. It was a kind of a healthy conversation with you over the topic, and we'll find more opportunities in future to do so.
Thank you. Thank you very much.
Thank you, ma'am. Bye.
On the ground is where I stand. Never give up, that was always the plan. It's so cold outside. I'm alone, I'm alright. It's so cold outside. I'm alone.